On December 25th, 2025, as families across the United States gathered to open presents and celebrate the holiday, a silent but violent financial earthquake was leveling the commodity markets in the East. While Western markets were closed for the holiday, the trading desks in Shanghai and Shenzhen witnessed something that shouldn't happen in a functioning global economy. Physical silver simply vanished. It was not just a price spike. It was a total evaporation of available metal. Traders who had spent decades in the pits watched in disbelief as bid prices for physical silver bars climbed to record local levels, yet no one was willing to sell. By the time the sun set over the Huangpu River, the Shanghai Gold Exchange was signaling a condition that sends shivers down the spine of any institutional treasurer: extreme backwardation. In the world of professional commodities trading, backwardation is a technical state where the spot price, the price for immediate delivery, is significantly higher than the futures price. This is the ultimate red alert. It tells us that the market is no longer a mechanism for price discovery, but a theater of desperation. It means that industrial users and major banks are so terrified of not having physical metal in their hands today that they are willing to pay a massive premium rather than wait for a cheaper delivery in 3 months. Under normal circumstances, silver is an abundant industrial commodity. You should never have to pay a premium for immediate delivery unless the supply chain is fundamentally broken. Think of it like this. If you go to a car dealership and they tell you that a car delivered today costs $100,000, but the same car delivered in January costs $70,000, the only reason you pay the premium is if you are certain the January car will never arrive. Just 24 hours later, as the New York markets opened on December 26th, the contagion crossed the ocean. Silver hit an all-time high of $79.39 per ounce. To put that in perspective, that represents a year-to-date gain of 169%. If you had allocated capital to silver at the start of 2025, your wealth would have nearly tripled, while the Standard & Poor 500 delivered a respectable but distant 25%. This is the kind of wealth migration that usually dominates every headline on CNBC and the front page of the Wall Street Journal. Yet, the silence from the mainstream financial media has been deafening. Your financial advisor likely hasn't called you. The major networks are focusing on retail sales figures and political theater, ignoring the fact that the primary conductor of the modern digital world is undergoing a systemic repricing. Whenever you see a massive move in a critical asset accompanied by absolute silence from the establishment, you are witnessing a managed narrative. There are participants in this market who are currently trapped in short positions so large they threaten the stability of the clearinghouses themselves. They need you to stay quiet. They need the general public to remain focused on paper assets while they scramble behind the scenes to find physical metal that, according to the data, simply does not exist in the vaults anymore. We are no longer talking about a speculative bubble. We are witnessing the death of the paper silver market and the birth of a new physical reality. To understand why silver exploded in late December, we must look beyond the trading screens and toward the Caribbean Sea. While the financial world was distracted by year-end bonus cycles, a massive geopolitical shift was orchestrated by Washington. In a move that caught global intelligence agencies off guard, President Trump deployed 15,000 troops and 11 warships to the coast of South America. Their mission was clear and uncompromising: a total oil blockade against Venezuela. This was not a standard diplomatic pressure campaign. It was a physical severance of 600,000 barrels of oil per day. For the global energy market, this was a sudden heart attack, but for China, it was an existential threat. A significant portion of Venezuelan heavy crude is committed to Chinese refineries. These facilities are specifically calibrated to process this type of thick, high-sulfur oil. When you cut off that supply, you do not just raise the price of gasoline, you threaten the stability of the Chinese industrial machine. In response, the leadership in Beijing did exactly what any superpower would do when faced with a resource siege. They began a massive, coordinated accumulation of strategic hard assets. When a nation fears its energy supply is being strangled, it stops trusting paper currency and starts hoarding everything of tangible value. Copper, aluminum, and most importantly, precious metals became the new front line of defense. This blockade acted as the ultimate catalyst for a silver market that was already stretched to its breaking point. You have to realize that China is the world leader in solar energy and electric vehicle manufacturing. Both of these industries are the primary drivers of silver consumption. If the Chinese government perceives that the United States is using its naval power to dictate terms in the energy market, they will naturally accelerate their transition toward energy independence. And that transition is built on a foundation of silver. According to customs data from late December, Chinese silver imports did not just increase, they spiked to levels that suggested a state-sponsored panic buy. This creates a deadly pincer movement for Western short sellers. On one side, you have the United States military restricting the flow of oil, which drives up the cost of everything. On the other side, you have the Chinese industrial complex absorbing every available ounce of silver on the spot market to hedge against future supply shocks. We are talking about a geopolitical earthquake that has shifted the tectonic plates of the commodity world. The blockade of Venezuela was the spark, but the dry tinder was the 5 years of structural deficits we have been tracking. When the world's largest manufacturer decides that it needs to own the physical metal rather than just trade the paper contract, the game of musical chairs ends abruptly. There are more players than there are chairs, and the music just stopped. While the geopolitical situation provided the spark, the gasoline was poured by the Federal Reserve in Washington. Just 2 weeks before the Christmas silver vanished, the Federal Open Market Committee concluded its final meeting of 2025. In a move that signaled a major shift in monetary policy, the Fed cut interest rates to a range of 3.75% to 4.0%. For the average consumer, this might look like a simple attempt to stimulate the housing market. But for a global financial expert, this was a clear admission that the central bank is trapped between a failing debt market and a surging commodity reality. When the Fed cuts rates, it intentionally devalues the purchasing power of the dollar to inject liquidity into the banking system. This makes dollars more abundant, but it also makes every dollar less valuable relative to things you cannot print. Historically, this has always been the primary driver for investors moving into hard assets. However, this time is different because the liquidity is hitting a market that is already facing a physical supply crisis. By lowering the cost of capital, the Fed essentially subsidized the very entities that are currently hoarding silver. Industrial giants can now borrow at lower rates to finance massive inventory builds, further stripping the market of available metal. According to the Federal Reserve weekly balance sheet releases, there was a significant expansion in currency swap lines with European and Japanese central banks in late December. These swap lines are designed to provide dollar liquidity to foreign banks so they can cover losses in the commodity markets without triggering a systemic collapse. Think about the irony here. The Fed is creating more dollars to help banks manage their failing short positions in silver. But by creating those dollars, they are fueling the very inflation that drives silver prices higher. It is a feedback loop that the central bank cannot escape. The Fed is now facing a choice between two equally devastating outcomes. If they raise rates to defend the dollar, they crash the stock market and the highly leveraged real estate sector. If they continue to cut rates and provide liquidity, they accelerate the flight toward gold and silver, eventually leading to a complete loss of confidence in paper currency. For the silver market, this means the monetary floor has been permanently raised. With interest rates falling and geopolitical tensions rising, the incentive to hold paper dollars is evaporating. Investors are looking at a central bank that has run out of moves, and they are choosing the safety of an asset that has no counterparty risk. The mathematical certainty of dollar devaluation is now the strongest wind at the back of the silver rally. To understand the gravity of the current situation, we must move beyond daily price fluctuations and examine the cold, hard mathematics of the silver market. We are currently navigating through what I call the structural deficit paradox. According to the 2025 World Silver Survey, the global market has just completed its 5th consecutive year of structural deficits. This is not a temporary imbalance or a cyclical shortage that will resolve itself when prices rise. A structural deficit means that even at record high prices, the world is consuming silver at a rate that the mining industry simply cannot match. The cumulative deficit over the last 5 years has reached a staggering 800 million ounces. To visualize the scale of this catastrophe, you must realize that 800 million ounces is roughly equivalent to the entire global mine production for 1 full year. We have effectively erased 1 year of global supply from the Earth's inventories. This silver has not been moved from one vault to another. It has been consumed, embedded in industrial products, and functionally removed from the circular economy. In previous decades, a spike in silver prices would lead to a flood of scrap metal and jewelry being sold back into the market, but that mechanism is failing. The paradox lies in the fact that as silver becomes more essential to our high-tech existence, it becomes less available for investment. In the 20th century, silver was primarily a monetary and decorative metal. When the price went up, people sold their silverware. In 2025, silver is a critical industrial component. You cannot sell the silver inside your smartphone or the silver paste on your solar panels without destroying the utility of the product itself. This is what experts call destructive consumption. The metal is being locked away in millions of devices and infrastructure projects where the cost of recycling is 10 times higher than the value of the metal recovered. According to data from the Silver Institute, total silver demand in 2025 reached 930 million ounces, while total mine production struggled to hit 813 million ounces. This created an annual shortfall of 117 million ounces that had to be filled by draining existing stockpiles. But you can only drain a vault for so long before you hit the bottom. We are approaching the mathematical inflection point where the remaining above-ground stocks are held by entities who have no intention of selling. When you have a structural deficit that cannot be solved by higher prices, the market enters a phase of violent repricing. The current $85 target is not a guess. It is the price level required to force a change in consumption behavior, and even that may not be enough. We have reached a point in history where silver is being swallowed by a massive industrial black hole, and the primary driver is the global transition to green energy. For decades, silver was seen as a luxury or a hedge against inflation. In 2025, it has become the indispensable oxygen of the modern world. According to the World Bank renewable energy tracking data, the solar photovoltaic industry alone consumed approximately 30% of total industrial silver demand this year. Every solar panel installed on a roof or in a massive desert farm contains silver paste that is essential for conducting electricity. There is no cost-effective substitute. If you want solar power, you must have silver. But the story deepens when we look at the transportation sector. According to the International Energy Agency Transportation Report, global electric vehicle sales reached 18 million units in 2025. This is a critical metric because a traditional internal combustion engine vehicle uses less than 1 ounce of silver. In contrast, a modern electric vehicle like a Tesla or a high-end European EV requires between 5 and 10 ounces per car. Some luxury models with advanced autonomous driving features can contain up to 25 ounces. This means that as the world moves away from gasoline, we are increasing our silver consumption by 500 to 1,000% per vehicle. This creates what engineers call a non-elastic demand curve. If you're a manufacturer like Ford, Volkswagen, or BYD, and you have committed billions of dollars to electric vehicle production lines, you cannot stop production because the price of silver moved from $30 to $80. The cost of the silver is still a small fraction of the total car price, but without that silver, the car cannot function. You will pay whatever the market demands to secure your supply chain. This is why industrial users are now competing directly with investors for every available ounce. Furthermore, we must consider the explosion of artificial intelligence and 5G infrastructure. These technologies rely on massive data centers and high-frequency switching components, all of which require the superior conductivity of silver. Unlike the investment silver sitting in a vault, this industrial silver is effectively destroyed upon use. It is dispersed into millions of circuit boards and energy cells where it remains forever. We are consuming our strategic reserves to build the digital and green future, and the math shows we are running out of the very material required to finish the job. According to industry demand data, industrial applications alone consumed over 700 million ounces in 2025. When you subtract that from the total mine supply, there is almost nothing left for the rest of the world. There is a dangerous misconception among casual observers that a higher silver price will naturally lead to a massive surge in mining production. This is the mining myth, and it ignores the geological and economic reality of how silver is actually extracted from the earth. According to recent data from the Silver Institute and S&P Global Market Intelligence, approximately 70 to 80% of the world's silver is not mined directly as silver. Instead, it is produced as a byproduct of mining other metals, primarily copper, zinc, and lead. This creates what economists call extreme supply inelasticity. Consider a massive copper mine in Chile or a zinc operation in Australia. If the price of silver doubles or triples, that mine cannot simply produce more silver. Their production levels are dictated by the price and demand for copper or zinc. To get 10% more silver, they would have to mine 10% more copper. If the copper market is oversupplied or if prices are flat, it makes zero economic sense for them to expand their entire multi-billion-dollar operation just to capture a spike in a byproduct metal. In 2025, we have seen this play out in real time. Despite silver prices surging over 100%, major primary silver producers like Fresnillo have reported production declines of over 8% due to labor issues and lower ore grades. Furthermore, even for primary silver mines, the timeline to bring a new discovery to production is not measured in months. It is measured in years. According to S&P Global data on mining operations, it takes an average of 7 to 10 years to move a major mine from the initial discovery phase through permitting, feasibility studies, and construction before a single ounce of metal is poured. We are currently facing the consequences of a decade of underinvestment in exploration. Even with the current price incentives, the new supply needed to close the 800 million ounce deficit is not coming until well after 2030. This means the market is mathematically broken at the supply level. We are living off the accumulated inventories of the past, and those inventories are being liquidated at an alarming rate. In 2025, while the world was looking for a supply response, we actually saw total global mined silver supply remain flat at approximately 813 million ounces. We are running a high-tech world on a mid-tier mining infrastructure that cannot keep up. The mining industry is not a light switch that you can just flip when the price hits $80. It is a slow, heavy machine that is currently running at maximum capacity with no reserve gear. We are currently witnessing what historians will describe as the great decoupling of the precious metals market. For decades, the global price of silver has been determined by the trading of paper contracts on the COMEX in New York and the London Bullion Market Association. In this system, thousands of ounces of silver can be traded in seconds without a single physical bar ever moving. It is a system built on the assumption that only a tiny fraction of contract holders will ever ask for physical delivery. But in December 2025, that assumption was shattered. According to COMEX warehouse reports from early December, we saw a physical vault drain emergency. In the first 4 trading days of the month alone, more than 60% of all registered silver, the metal specifically designated for delivery, was claimed by contract holders. This is not just a high-volume month. This is a run on the bank. When 60% of your deliverable inventory disappears in 96 hours, the exchange is no longer a marketplace. It is a crime scene of liquidity. The registered silver inventories at the COMEX, which typically fluctuate between 150 and 250 million ounces, plummeted as industrial users and institutional funds converted their paper promises into physical reality. This has led to an explosion in lease rates. In October 2025, silver lease rates spiked to nearly 40%. To put that in context, under normal conditions, you can lease silver for less than 1%. A 40% lease rate is the market screaming that there is no metal available for borrow. It is the cost of desperation. This divorce between paper and physical is best seen in the retail premiums. While the screen price on the COMEX might show $79, you cannot actually buy silver at that price. If you want to hold an American Silver Eagle or a 100-ounce bar in your hand, you are paying premiums of 15 to 20% above the spot price. In London, the world's main spot trading hub, inventories have been drained to support the COMEX, leading to a massive arbitrage gap where metal is being flown, not shipped, across the Atlantic just to keep the New York Exchange from defaulting. We are watching the collapse of the paper leverage system. When the owners of paper silver realize that there are 100 claims for every 1 physical ounce in the vault, the rush for the exit will turn the current rally into a vertical moonshot. To understand the mathematical inevitability of the silver price explosion, we must examine the oldest relationship in the history of money, the gold-silver ratio. This ratio represents the number of ounces of silver required to purchase a single ounce of gold. For centuries, this was fixed by law at around 15 to 1. In April 2025, however, we saw a staggering anomaly where the ratio spiked above 105 to 1. This extreme level has historically been a flashing green light for institutional investors, signaling that silver is absurdly undervalued relative to its yellow cousin. As we enter the final days of 2025, the gold-silver ratio has begun a violent compression. According to recent data from the World Gold Council, gold has just crossed the historic $4,500 mark, fueled by unprecedented central bank buying from nations like Poland, China, and Brazil. This creates a massive problem for the large bullion banks holding short positions. Because silver is a high beta version of gold, it typically moves with much greater velocity once it begins to catch up. When gold hits 50 record highs in a single year, it exerts an irresistible upward pull on silver through the mechanism of mean reversion. This is where the algorithmic doom loop enters the picture. In modern trading, over 80% of volume is driven by high-frequency trading systems and machine learning models. These algorithms are programmed to monitor the gold-silver ratio 24 hours a day. When the ratio stretches too far beyond the historical 30-year average of 68-1, these systems automatically trigger massive buy orders for silver and sell orders for gold to capture the closing of the gap. By late December, the ratio had already collapsed from 105 to approximately 60. This catch-up phase has seen silver deliver a whopping 158% return year-to-date, far outpacing gold's 72% gain. The doom loop occurs because the more silver rallies, the more it triggers technical breakouts that attract momentum following algorithms. These systems do not care about the geopolitical blockade or industrial supply deficits. They only care about price velocity and mathematical correlations. As silver breaches key resistance levels like $55 and then $75, it activates a secondary layer of buying from volatility-adjusted position sizing models. The traditional tools used by banks to suppress prices, such as dumping paper contracts in the middle of the night, are now being overwhelmed by the sheer scale of algorithmic and physical demand. We are watching a mathematical correction turn into a systemic runaway event, where the ratio could potentially drive silver toward $85 or even $100 just to return to its historical equilibrium. As we approach the final hours of 2025, a shadow has fallen over the traditional financial centers. While the public remains focused on holiday festivities, high-level industry sources indicate that a series of non-public emergency discussions have taken place between major bullion banks, primary silver miners, and industrial tech giants. These are not regulatory hearings, they are crisis management sessions. The core of these meetings is a terrifying realization. The mechanisms used to control the silver price for the last 40 years are no longer functioning. The goal of these stakeholders is no longer profit maximization, but the preservation of supply chain integrity. The whispered price target emerging from these closed-door sessions is $85 per ounce. This is not an arbitrary number pulled from thin air. It is a mathematical necessity. In the world of technical analysis, $85 represents the 1.272 Fibonacci extension from the critical $50 breakout. For the banks, $85 is the pain threshold where they must decide whether to continue fighting the physical market or surrender their short positions. It is the level where industrial users are being told they must lock in long-term supply contracts or risk complete production shutdowns in 2026. But the targets do not stop at 85. According to the latest reports from Citibank and Bank of America, the momentum is shifting toward triple digits. Citi has recently raised its outlook, pointing toward $110 in the second half of 2026, driven by an acute shortage in the electric vehicle sector. Goldman Sachs, while more conservative, now views a range of $85 to $100 as a realistic outcome if the green transition continues at its current pace. Even more aggressive forecasts, such as those from prominent market analysts, suggest that if the gold-silver ratio returns to its historical mean of 35 to 1, we could see silver testing $200 per ounce. The $85 target is the first major psychological fortress. Once breached, it creates a vacuum of sell orders. According to data from the Silver Users Association, major consumers have already shifted their procurement strategy from just-in-time to just-in-case. They are no longer buying what they need for the next 3 months. They are attempting to buy what they need for the next 2 years. This panic inventory building is what professional traders call a feedback loop. The higher the price goes, the more industrial users fear a shortage, the more they buy, which in turn drives the price even higher. We are no longer looking at a standard bull market. We are looking at a systematic repricing of a critical mineral that was undervalued for half a century. The emergency meetings are the final warning, the floor is rising, and $85 is just the beginning of the new reality. As we stand on the threshold of Monday, December 30th, the final trading window of 2025 is about to open. This is not just another session on the calendar, it is the Monday reset. After a week where holiday liquidity thinness allowed silver to rocket to $79.39, the return of full institutional participation in Asian and European markets will act as a moment of truth for the global financial system. According to the latest market data, silver has entered 2026 price discovery territory, and the opening bell in Shanghai will likely set a tone that resonates throughout the entire decade. The immediate catalyst to watch is the implementation of new export restrictions. Reports from high-level industry analysts indicate that China is prepared to limit silver exports starting January 1st, 2026, to protect its own domestic green energy and semiconductor industries. This moves silver into the same strategic category as rare earth metals. If the world's primary refiner and consumer of silver